In this one, we're going to take a look at flat market strategy. So what's the difference between choppy and flat? Well, choppy is back and forth where you see peaks and valleys. But when you get a flat market, there are no peaks and valleys. Not really. And that is what we're looking at in a couple different areas in this chart. Flat markets are the worst, quite frankly. They don't give you much to work with. You can see, like, this is a 15-minute chart, and yes, it's zoomed out, but you can see we didn't do anything most of that day. We didn't do anything most of this day. And quite frankly, there isn't much to do with a flat market. Each one of these 15-minute candles tell you that the market just has no desire to go anywhere. So the best strategy for dealing with a flat market is letting it tell you where it wants to go. Ultimately, a flat market typically is nothing more than consolidation. It's just a market that has no real catalyst to do anything. And you'll see that a lot when there's no earnings or anything anywhere near. This is a flat market here. Now this, I would consider a choppy market. We're in a range. While this technically is a range, we're talking about a range of 25 cents. We're not talking about a whole lot of trading. Now, you can zoom in and go back and forth and treat it as a choppy market on the 1-minute chart if you wish. But in a world where there's over 5,000 stocks to most of you available to trade, of stocks and ETFs and everything else, there's no point in doing that. You don't need to punish yourself like that. So keep that in mind. But when you do get these flat areas in these stocks that just really haven't gone anywhere, the next thing you're looking for is some type of volume spike. So, for example, here we did nothing for 24 hours, basically. Well, for a trading day. We rallied a little bit and just went sideways. You can see we get this huge, massive spike higher. $2 spike on this 15-minute candle. So here's the thing. Do you have any doubts as to where this market's trying to go? You can put your stop loss on the other side of that flattened area because you know that there are a ton of orders right here that would have to be taken out for you to be hurt. You may have to be patient. You may have to deal with a pullback. In this case, you really didn't. But a pullback is not that uncommon, and just recognize it's part of the market structure you typically see. So you do have the option of waiting for a pullback to buy, but typically when you get an explosive candle like this after a market has done nothing, the pullbacks are very brief and very shallow. And you can see that with your stop here at, say, 29.30, and even if you bought here at 32, you're looking at about $2.50. You made $5 before the market flattened or got in a choppy range. So that was a 2-to-1 risk to reward ratio kind of built into this trade. You'll see this time and time again. You know, here is a massive sell-off. Now, I'm the first to admit that this would be difficult to start shorting down here after that move, but you can see that certainly it worked out. Same here in John Deere. You could call this choppy if you want. I call it flat because there aren't, you know, this is more choppy because it's a little wider. And there is a little bit of art to this. There is no, hey, this is a flat market because it's X amount of percentage move. It's more a visual thing. It's when you look at a market and you go, you know, there just isn't enough there back and forth for me to be bothered with. And then you get a volume spike like that, a massive candlestick. That tells you right there that the market's ready to go. And that's really the only way to handle these markets that I've found that's even remotely reliable. Beyond that, what you really want to see, and in this case in Deere it was obvious, we had been bullish for quite some time. So it shows you that there's more conviction coming. We like continuation in these setups.